Hey, welcome back to the What the Wealthy Do podcast, the podcast where we break down the money moves that the wealthy and sophisticated investors make and show you how to apply those same strategies on your own personal wealth building journey. I am your host, Stephanie Dorsey. I'm the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that is focused on providing women and people of color access to an institutional quality portfolio of alternative investments. Today, we are tackling something a lot of you are, I'm gonna just keep it a buck, y'all not doing it well, like you not. And after this episode, you will be doing it better. And we're talking about what happens to your 401k when you leave your old job. So if you've changed jobs in the past 10 years and didn't roll over your 401k, you probably have money sitting in an account somewhere with high fees, with limited investment options, and you've probably just forgotten about it entirely, and that money could have been working for you. And so you need to think about your dollars as little soldiers, and we don't leave no man left behind. Like, we just don't do that. So when you leave a job, and I need you to take your money with you and be very intentional about where you put your money next. And so that's what we're going to talk about today. As always, before we get started, this podcast is intended to provide financial education and not financial advice. So let's get into it. All right. So when you leave an employer, you basically have four options for what to do with your old 401k. Option one, you can leave it where it's sitting. And this is the easy thing to do, obviously, but old 401k plans usually have higher fees when you're no longer employed there. They have limited investment options. And if you change jobs a few times, you end up with money scattered everywhere. Option two, you can roll it over into your new employer's 401k. Everything stays in one place, but you're still limited to whatever investment options your new employer offers you. And if you leave that job too, you're back to square one. And there are just other limitations with the type of investments that you can make with your current employer. Option three, you can roll it into an IRA that gives you full control over your investments, lower fees, and one account to manage. And this is what most of you should do. And we'll talk about the two different types of IRAs that you should be considering. And then option four, you can cash it out. Girl, bye. Like, I don't even know why we put this on here. You do not want to do that because you'll be paying ordinary income taxes plus a 10% early withdrawal penalty if you're under 59 and a half. And so you could lose 30 to 40% of your money instantly. Like, it's an option. Yes, it's clearly the worst option. And you would never do that. I know you wouldn't. So let's talk about really like the nuanced version of option three, which is moving it to an IRA that most people skip. And that's the traditional IRA versus the self-directed IRA. And this is a decision most people don't even know that they're making when they decide to put it in the traditional IRA. You're saying, I'm not going to put it into a self-directed IRA, and you might not even realize that you're making that decision. So when you roll your 401k into an IRA, you're actually choosing between two different types of IRAs. A traditional IRA at a regular brokerage like Fidelity, Vanguard, Schwab lets you invest in everything that a brokerage offers. So that's stocks, bonds, mutual funds, ETFs, or exchange traded funds or target date funds. The big public market stuff is easy to set up. It's easy to manage. There are low fees on the account itself. But there is an alternative that, I guess, pun intended? Nah. Yeah, pun intended. There's an alternative of IRA that you could consider, and that's called the self-directed IRA. And a self-directed IRA is held at a specialty custodian, like companies like IRA Financial, Equity Trusts, and the like. It opens up a much wider universe of investments. And so you can invest in alternatives like real estate, private equity, private credit, syndications, crypto, precious metals, venture capital, hedge funds, and all other kinds of alternatives. Basically, these are the other type of investments that the ultra wealthy invest in. And that's basically, y'all hear me talk about this all the time. And so this is your vehicle to allow you to get access to those type of investments. So how do you decide? One, okay, you should use a traditional IRA if you're going to only invest in the public markets. If you only care about stocks, bonds, and the like, that's where you should be. If you're under $50,000 and you just want simplicity and you don't have a specific alternative investment in mind, sure, stick with the traditional route. The fees are basically zero. The interface is easy. The customer service is pretty solid. Sure, right? But If you want to invest in alternatives, then you need to go the self-directed IRA route. Ideally, you want to have a couple dollars, right? You want to have $25,000, $50,000 because the annual fees are around $300 or $100 to $800. And you do want to be thoughtful about that additional cost that you will be paying if you open that account. Right? So you kind of want to have a little bit more money in that account to make it worth your while, especially because like if you're only going to open that account and your money is only going to be invested in public equities, you don't have to do that. However, one thing you can do is if you know, for instance, that I do want to invest in alternatives, even though I don't have a particular investment in mind, but I know that this is something that I'm thinking about. What you can do is always just open up a regular traditional IRA. And then once you identify the alternative investment you want to make, you can open up a self-directed after that and just divert money to it because it's pretty easy and pretty fast to do. It's only a couple of weeks to open it and fund it. So, and the wealthy people, most of them have both, right? They keep the bulk of their rollover in a traditional platform and they open a separate self-directed IRA for alternative allocation. A few things to note about the self-directed IRA specifically is that the custodian doesn't give you investment advice, right? They just hold the assets for you and process the paperwork. And you are responsible for vetting your own deals. And there are prohibited transaction rules. Like you can't invest in something you or a family member already owns. You can't personally benefit from the asset. So like you can't be like, oh, I'm going to use this to buy a vacation home that I'm going to rent out because that is a double dipping. IRS is going to be like, And you can't live in the real estate that the IRA owns. So violating these rules can blow up the entire IRA's tax deferred status. So if you go this route, you need to actually understand these rules. Bottom line is most people start with the traditional IRA at a brokerage. And when your account grows and you want exposure to alternatives, you add a self-directed IRA alongside it. I said that already. And so before we go further, you do need to know what type of 401k you have because that determines where it gets rolled into. So if you have a traditional 401k with pre-tax contributions, that is rolled into a traditional IRA. You will pay taxes when you start to withdraw in retirement. However, if you have a Roth 401k money and that's made with after-tax contributions, you need to roll that into a Roth IRA, and that will allow you to make tax-free withdrawals in retirement. If you have both, you need to split them. Traditional portion to the traditional IRA, Roth portion to the Roth IRA. Quick warning, do not roll a traditional 401k directly into a Roth IRA without understanding what you're doing because that's going to be considered a Roth conversion and you're going to owe some taxes on the entire amount in the year you convert. And so we covered Roth conversions and the pro rata rule in a separate episode. Go listen to them before moving things to a Roth IRA. But for today, we're only talking about direct rollovers. All right, moving money without triggering taxes. So how do you actually do this? Let's walk through the process. Step one, you want to open your IRA. You want to go to your brokerage's website, click open an account, select rollover IRA. And some call it a rollover, some call it a traditional. Either one works. And you want to provide your personal info and then designate a beneficiary and hit submit. You should be approved within a day or two. Step two, then you want to contact your old 401k provider. And if you don't know who that is, check your old pay stubs, log into your old employer's HR portal or call HR and figure out who's who. It's probably one of the common ones unless you have a smaller company, but whatever, you can find it. Give them a call. They'll help you. This is what you're going to say when you call the old 401k. I left my employer and I want to do a direct rollover of my 401k to an IRA. And they'll ask you for your account number, your social security number, and where you want the money sent. Give them the name of your new IRA provider and your new IRA account number, and they'll send you a rollover form to fill out and assign. And you need to choose the right one. If you're at a place where you're like, okay, girl, I got all this information and I still don't know where to get started, you should look into joining me and some amazing amazing women in the Sovereign Collective where we are collectively working together to support each other on our own independent wealth journeys. You can look us up at joinsovereign.co, where we are holding each other accountable and supporting each other as we build the investment portfolios of our dreams. Now, this next part is critical because there are two types of rollovers. You want to choose a direct rollover, right? This sends money straight from the old 401k to your new IRA. It never comes to you. You never touch it. There are no taxes, no penalties involved, right? If you do an indirect rollover, they're going to send you a check. And then they're also going to withhold 20% of it for your taxes. And then you have 60 days to deposit the full amount, including the 20% they withheld, into your new IRA, meaning you have to come up with that 20% out of your pocket. And if you miss the 60-day deadline, the whole thing becomes a taxable distribution with penalties. Just always go the direct rollover route because it just can turn into a whole mess. All right. And then the next step, you just wait, right? Electronic transfers can last 1 to 2 weeks. Paper checks take 2 to 4 weeks. Be patient. Your old provider will liquidate your investments to cash, then send the funds to your new IRA. All right. And then the last step, and this is a step that a lot of people forget. Don't forget to invest your money. Invest your money. Everybody say invest your money. Turn to your neighbor and say invest your money. Like when you get the money and you put it into your new IRA account, put the money to work. Make sure you invest it, because otherwise it's just sitting there, not making you no money. So we don't want to do that. So make sure, log in, go to trade or buy, pick your investments, index funds, individual stocks, target date funds, ETFs, whatever fits your plan, but invest that entire balance, then set it and forget it. Don't let it just languish. All right. So if you've changed jobs a few times, you might have 401ks scattered across 3 or 4 or even 5 different employers. And so you want to consolidate everything into one rollover IRA because this is easier to manage. It reduces complexity. You're going to have lower aggregate fees. You're going to have better investment options. And it's just easier to rebalance regularly and track your performance. And honestly, you just need to stop losing track. You will stop losing track of your money. And so you just want to roll over each old 401k into the same rollover IRA. So that process that we just talked about, you just rinse and repeat. So if you have $50,000 over here, $20,000 over here, $30,000 over here, you're going to move them all into the same place. So you have $100,000 in one rollover IRA. And a quick note, if you're planning to do a backdoor Roth contributions in the future, rolling a traditional 401k into a traditional IRA can mess that up because of the pro rata rule. This is very important. So in that case, rolling into your new employer's 401k might be the better move if it's already on your radar to do backdoor Roth conversions. But listen to the backdoor Roth conversion episode just to make sure. That's a very, 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 very important point. And just a quick note, if you have a Roth 401k, the process is the same, except the destination will go to a Roth IRA. The rollover itself is tax-free. The withdrawals and retirement are tax-free. You just want to do that. One thing to remember is the 5-year rule. Before you can withdraw earnings tax-free from a Roth IRA, the account has to have been open for at least 5 years. So contributions you can pull at any time, but earnings have a clock. So pro tip, if you don't already have a Roth IRA, you might as well just open one now, because even if you put $100 in it, that starts the 5-year clock running. And so by the time you actually need the money, the clock has already run out. This is for my folks who are 55, 54. This is for y'all. Like, open a Roth IRA account. Get it popping. Like, go ahead and go on and get it popping. Anyway, here's some common mistakes to avoid. Let's do a little quick hit before we get up out of here. Don't cash out your 401k. Like, I think y'all know that, but don't do it because you're going to lose 30 to 40% in taxes and penalties. You also don't choose an indirect rollover. You choose a direct rollover every time because it's just easy. You don't want these problems and you don't need to spend money. It's easy. Don't forget to invest your rollover IRA. Once your money gets there, your money will sit in cash earning nothing and you will forget And it's a common mistake. And don't leave your old 401k scattered else all over the place, right? Consolidate. Get your stuff together. Your money ain't gonna manage itself. And it's your job. Ain't nobody gonna care about your money the way you care about your money. You cannot outsource this. So go on and consolidate your money into a traditional IRA or whatever, one account, and manage it. Don't mix Roth and traditional IRAs. You want to do Roth to Roth, traditional to traditional. What happens is if you put a Roth in your traditional, you're gonna lose all of your benefits of the Roth. And you end up paying taxes on money you already pay taxes on. And don't open a self-directed IRA if you just gonna buy index funds and buy stocks because you wasting money. You want to make sure you can't be wasting money. We work too hard. No money waste. We don't believe in waste over here. So here's the takeaway. When you leave a job, don't leave your 401k behind. No soldiers left behind. Your money are soldiers, and they're soldiers working for you. So we're not leaving none of them behind. So you want to go ahead and roll that into an IRA, either self-directed or traditional right away, so that you can take control, lower your fees, consolidate your accounts, and build wealth on your terms. All right, y'all, that's it for today. Today we talked about how to roll your old 401k into an IRA, be it traditional, Roth, or self-directed. If this episode helped you, please share it with a friend who has old 401k sitting around, because we know better. I want you to please follow, subscribe, and drop us a 5-star review wherever you get your podcasts. We are on Apple, Spotify, and YouTube. And yeah, I love y'all. This is fun. Okay, I'll see y'all next week. Bye.